Most global trade does not use the currency of the countries involved. Oil traded between Asia and Europe is often priced in dollars. Corporate debt issued outside the United States is frequently denominated in dollars. Even banks operating in foreign jurisdictions depend on dollar funding markets. The modern financial system is built around a single currency that most of the world does not control. This structure creates efficiency and stability during calm periods. It also creates dependency. When access to dollar funding tightens, financial stress can spread far beyond U.S. borders. The dollar system is not simply about exchange rates or trade balances. It is about liquidity, trust, and global funding networks. This is the story of how one currency became the backbone of global finance. The U.S. dollar occupies a unique position in the global economy. It functions as the primary reserve currency, the dominant unit of international trade, and the preferred denomination for global debt. Central banks hold dollar reserves to stabilize their currencies. Corporations borrow in dollars because international investors prefer the liquidity of dollar-denominated markets. Banks outside the United States also rely on dollar funding to finance global operations. These institutions obtain dollars through foreign exchange swaps, repo markets, or borrowing from other banks. This network forms what economists call the global dollar system. Unlike domestic monetary systems, this structure extends across jurisdictions. Many participants depend on dollar liquidity even though they operate outside U.S. regulatory authority. The result is a financial system where the supply of dollars influences credit conditions worldwide. The dollar system promised efficiency and stability. A single dominant currency simplified global trade and investment. Pricing assets in dollars reduced transaction costs and improved comparability across markets. Investors trusted U.S. financial markets because of their size and transparency. Treasury securities provided a deep and liquid asset considered safe during uncertainty. For multinational corporations, issuing debt in dollars expanded access to international capital. For banks, dollar funding allowed participation in global lending. The system appeared mutually beneficial. The United States provided liquidity through its financial markets, while the rest of the world used those markets to finance trade and investment. The promise was continuity. As long as the dollar remained trusted, global capital flows would remain stable. But reliance on a single currency also concentrated risk. The dollar's dominance expanded after the Second World War through the Bretton Woods system. Even after that framework dissolved in the 1970s, dollar usage continued to grow. Oil markets adopted dollar pricing. International lending shifted toward dollar-denominated instruments. U.S. financial markets expanded rapidly, offering unmatched liquidity. Globalization reinforced this trend. As trade volumes increased, so did demand for a common currency. Banks developed offshore dollar markets, allowing institutions outside the United States to lend and borrow dollars. These euro-dollar markets grew to enormous scale. The rise of derivatives, repo markets, and cross-border banking integrated these dollar funding networks further. The dollar system was not imposed by force. It emerged through market preference for liquidity and depth. Over time, it became structural infrastructure for global finance. The vulnerability of the dollar system appears during funding stress. Institutions outside the United States often hold dollar assets, but fund them through short-term borrowing. When funding markets tighten, access to dollars can become scarce. Exchange rates move rapidly. Institutions scramble to secure liquidity. This dynamic occurred during the global financial crisis. Non-U.S. banks faced shortages of dollar funding as credit markets froze. Central banks responded by establishing swap lines with the U.S. Federal Reserve to supply dollars internationally. These swap lines effectively extended the Federal Reserve's liquidity support beyond U.S. borders. The system depends on confidence that dollar liquidity will remain available. If funding dries up, global credit conditions tighten quickly. The paradox is clear. The currency that stabilizes global markets can also transmit stress across them. Dollar funding shortages do not originate from exchange rate movements alone. They arise when institutions dependent on short-term borrowing cannot roll funding. Because many global financial contracts are denominated in dollars, disruption in funding markets can affect economies that do not control the currency itself. The system functions smoothly when liquidity is abundant. It becomes fragile when that liquidity contracts. A severe dollar funding collapse would appear as a global liquidity crisis. Banks and corporations would struggle to refinance dollar obligations. Currency markets would become volatile. International trade financing could tighten. Central banks would likely expand swap lines and liquidity facilities to stabilize markets. The collapse would not represent failure of the dollar itself. It would represent stress within the network that distributes dollar liquidity globally. The key variable is coordination. If central banks act quickly, disruptions remain contained. If coordination falters, funding shortages can propagate rapidly. After episodes of dollar funding stress, global institutions adjust risk management practices. Reserves increase, liquidity buffers expand, yet the structure remains intact. The dollar continues to dominate international finance because alternatives lack comparable liquidity. Dependence persists because replacing the system would require rebuilding global financial infrastructure. The dollar system adapts rather than disappears. The dollar system demonstrates how financial power emerges from liquidity rather than decree. Markets gravitate toward assets and currencies that provide depth and reliability. This dominance creates stability during calm periods, but concentration during stress. The world depends on a currency issued by a single nation. That dependence shapes global finance in ways often invisible during stability. Understanding the dollar system means understanding how liquidity travels across borders and how quickly it can retreat.